Hi everyone, welcome back to the channel. Today I want to share with you my experience with a powerful options strategy called cash secured puts. This is a smart way to generate income while potentially buying stocks that you otherwise want to buy at a discount. So I will walk you through how I use this strategy for SOFI and Walmart and explain the process step by step and share why I think it's a great tool for long-term investors like me. And even Warren Buffett reportedly uses it. Now, I'm always the first one to say trading and investing comes with risks. So this video therefore is meant for educational purposes and also entertainment purposes only. You should always do your own due diligence. Now, let's get down to the basics. What is a cash secured put in the options strategy playbook? Now, a cash secured put is an options strategy where you sell an option on a stock you are willing to buy. You set aside enough cash with your account to purchase the stock at a strike price if that option gets exercised. In return, you earn an upfront premium from selling the put. Now, for those who don't know, an option basically it's an instrument that, in this case, let's say I'll give you an example of SOFI, which is a stock more like a digital bank that is based in the US. And what happens is that this is a digital bank. This is a stock that has been growing. It has been profitable. I've done research. Walmart is another retail that is based in the US and also in Canada here, to the extent that I know there's Walmart here, right? So it's a grocery store. They have a strong balance sheet. I've done research and I otherwise want to hold these stocks. So that is the key thing. Now, here is how it works. If the stock stays above the strike price until expiration date, in this case, I took for 1 week, right? On Friday, I'm recording this on the 31st of March 2025, and it applies even when you watch this video. You can do for 2 weeks, 3 weeks, or further out from the date of doing that. Now, if the stock stays above the strike price until expiration date, the options expire worthless, and in this case, you keep the premium as profit. But if the stock drops below the strike price, you will be assigned and required to buy 100 shares per contract at that price. The good news is your effective cost is reduced by the premium received. Now, let's do an example of what I actually did. Now, let me show you my first trade using this strategy with SOFI. At the time, SOFI was trading at around $11.46 per share. And I sold 3 cash secured puts, right? That is 3 contracts with a strike price of $11, and I got 20 cents premium per contract. So that means I got paid $60. Now, what this means is that I set aside $3,300 in my account to cover for the potential assignment, right? In other words, the strike price, which is $11 times 100 shares, which is equivalent of 1 option contract times the 3 contracts that I got. So that is $3,300. Now, if SOFI stock stays above $11 by end of the week, I will keep the premium. That is, I will earn the $60 for the 3 contracts, right? But if SOFI drops below $11, I will be assigned to and supposed to buy the 300 shares, that is the 3 contracts that I got at $11 each. After factoring in the premium of 20 cents, my effective cost would be $10.80. That's a nice discount, right? Even if it's at, let's say, $10.99. Now I can either maybe just, buy it at after being assigned and then just sell it at the market price if it's above, if I want to, right? But this trade works out for me perfectly because I'm bullish on SOFI for the long term and I'm happy to own the shares at that price. Now, I did another trade for Walmart, which is a very interesting stock that I've been doing covered calls strategies, and I've done a video to explain what are covered calls there. But that's what I did for Walmart. I sold one cash secured put with a strike price of $85 expiring on April 4th. Now, because of the price which Walmart was currently trading, let's say it was trading at $86 or whatever. In this case, my strike price is 8,500. What it means is I should have 8,500 US dollars in my account in case I'm assigned. If it is, let's say it closes, the trading day in April 4th is $84.99, I might be assigned that. In other words, I will be forced to buy it at $85. Fine. Now, because I got the premium for 50 cents, right? It means my actual cost, effective cost, would be that strike price. Let's say it's $84.99 minus 50 cents. So that would be $84.49. In other words, I could still just get the shares, sell them for $84.99, right? And still make another profit in that case. So, but if it goes down, let's say it goes to $84, now that's where the issue is. If you are not comfortable holding the stock, then you can possibly have to sell it for a loss, right? So that's why I only do it for the stocks that I otherwise want to hold for the long term. So in my case, both these trades align with my investing philosophy. Only I like to sell puts on the stocks that I am comfortable owning for the long term. Now, let's talk about how and why this strategy is powerful. Number one, for income generation, I'm at a point where I want weekly income. Let's say in this case, I got 110 US dollars this week, right? If I close the week on Friday, I already got the 110, that is $60 for the SOFI stock, 3 contracts, 20 cents each, that's $60, and then $50, 50 cents, that is $50 for one contract for Walmart. Now, it means I got $110. If I repeat it next week and I'm not assigned and it closes above that price, but the key thing is I did the fundamental analysis. I understand their financials, their business, who manages these businesses, and I have conviction that these are wonderful stocks, right? So in that case, it's a win-win for me because I otherwise want to hold them. Now, the good thing, number two, is I end up buying stocks at lower prices. If it works out well, if I'm assigned, I can acquire these shares at an effective cost below the market price. So if the market price is above my effective price that I got in this case, after factoring in the premium, I could just buy them and sell them at the market price if it is higher. Now, the third point is that there's a defined risk. My maximum loss in this case is limited to owning the shares purchased at the strike price minus the premium received. Like I gave you an example. If Walmart, let's say it closes at $84.99, I get assigned, I would be forced to buy these shares for $85, the 100 shares, that would be 8,500. Now, because I already got 50 cents premium, right, in that contract, that is $50 because one contract is 100 units. That would mean that I would have $84.44. That would be my effective price for that. So I can still be assigned at 85 and I could still sell these shares at $84.99 and make another $49. So in total, I could make 49 plus 50, that is $99 in that trade, and repeat the process. Now, this approach is often called the poor man's wheel strategy because it combines income generation with the stock acquisition over time. Now, because let's say I'm assigned the shares for SOFI, those 300 shares, right? I got $60 already, right? And I have the 3 contracts. Now that I have the underlying shares for 300 shares for SOFI, I can now move on to another strategy of covered call strategy. In other words, the covered call, you are bullish. If you take a call in options trading, what it means is that I would believe that it will go up. But if I then do a covered call, in that case, let's say I write a covered call for $13 strike price, and then what that means, I get paid the premium, let's say another 20 cents, right? So I get maybe $60 for the 3 contracts for it, let's say to get to, let's say if it gets to $13, right? Now, what it means is that, let's say if SOFI doesn't get to $13, I would still just keep the premium, right? Or let's say if it goes to $20, then I will forgo the upside, potential upside. But in this case, I like the fact that I have a defined risk reward ratio. That's it for me. That is what is very important for me, because I like to have predetermined. I know, like, okay, this is going to be my profit or loss at the end of this week. Now, this approach, of course, just like any other strategies, it doesn't come without its own risks. If assigned, you may have to buy shares at a higher than market price if the stock price drops significantly below your strike price. However, the risk is manageable in this case because you are only selling puts of stocks that you believe in the long term. Just like what Warren Buffett reportedly does. If I like this stock, I can just hold it for some time, and that's fine. So to sum this up, my SOFI trade earned me $60 premiums, and for 3,320, that's a good return. So it gives me an opportunity to buy these shares at $10.80 if I'm assigned, like I explained above. Now, if my Walmart trade sets me up for another win, either collecting premiums or acquiring the shares for the company that I love, I would still write covered calls and make money. So either way, I'm winning. It's like we are playing with the casino. You are playing, you are gambling in the casino. But in this case, I am the casino. I am writing the covered call. I'm writing the covered secured puts, the puts in this case. I am selling the premium, the insurance in this case, right? So when I write the cash secured puts in this case, right? In this case, it's more like a covered call. In this case, the covered in this sense comes in the fact that I have the cash that is there to secure the shares. So the same goes with covered calls. Covered calls, I should have the underlying stocks, at least 100 shares. So I have 100 shares. So it's more like it's a deposit that I have to say, okay, I have this as my surety. Now, in conclusion, cash secured puts are an excellent tool for my conservative approach to investing because I can get to generate some income and build positions in quality stocks over time. So I take the cash that I collect from the premium and I can open another position potentially in the long term. So that's another thing. So over time, if I repeat it, I can possibly make money. But I will say this also in conclusion as well, that I do research, deep dive, financial, fundamental analysis, technical analysis, and have an idea of where I believe things could be. I could be wrong, but the good thing is my risk reward ratio is defined in that case. I get in that position knowing fully this is my maximum loss, this is my maximum profit, which is a cool thing in my view. Now, thanks for watching. Let me know if you have any questions on the comment section, and if you have tried cash secured puts, or if you have questions about this strategy, let me know, and I will put my website here if you want to book a one-on-one time to ask these questions. And of course, don't forget to like and subscribe and hit the notification bell for more investing tips. See you next time, and happy investing. Bye bye for now.